What if I told you that just for $100 you could actually own a piece of a luxury skyscraper, fine art, or even private equity, all thanks to blockchain? Real-world asset tokenization is transforming illiquid assets into more high liquidity investments, breaking those TradeFi's barriers. With a projected $30 trillion market by 2034, this shift is reshaping real estate, art and finance. Faster trades, fractional ownership, global access. This isn't just the future, it's happening now. Are you ready to ride the tokenization wave? So here's one of the rather interesting articles that I've come across from Mantra, who is one of the fintech players in the real-world assets tokenization space. Now, if you recall from one of my earlier videos on top of me, if you subscribe to my channel and have a peek at that video, it gives you the actual details of the world first ever real-world assets tokenization in the real estate investment space with a Dubai-based realtor. So if you have a few moments, subscribe and have a peek at that video for further details. So this is the same fintech that's actually pulled this article together, and the intention here is it discusses what are the 5 ways based on their experience to date how real-world asset tokenization, or just simply tokenization, is helping to transform that TradeFi, the traditional finance. The first point is striking, where it says that real-world assets tokenization is indeed modernizing traditional finance by making historically illiquid assets such as real estates, or it could be those assets that have a lengthy process of converting into cash, let's say, to more high liquid assets for further downstream investment opportunities. That's what is meant by illiquid or historically illiquid assets, in order to make them more accessible, driving more liquidity into the market, and as a result making it more efficient. So if you go into under the covers, it says that traditional finance is slowly but surely being carried out onto the blockchain as we speak. Now this trend may particularly benefit legacy assets, as I mentioned earlier on, such as real estate, even private equity and fine art and collectibles, which are challenging to buy and sell because, as I said earlier on, due to its lengthy processes and high cost and fragmented markets in which they position the sale of these assets. This is the predicament of traditional finance for these illiquid assets, and how RWA can help them transform into more highly liquid assets but onto the blockchain. So this process is called tokenization, which offers significant improvements for such industries. The technology allows for full or fractional asset ownership on-chain, which simplifies asset transfer. Now, RWA tokenization floods traditionally illiquid industries with liquidity and significantly expands such markets, thereby modernizing them. Now, this is an important aspect because, as I said at the very outset of this episode, this is the true intention, is to make those highly illiquid assets, particularly real estate. If you think about the first-time buyers who have it very difficult to go through the various pieces of the hurdles in order to get a mortgage, in order to procure a 5 or 10% outright deposit payment, in order to get access to its first property, get a bank loan for the remaining aspect of the value of the property they want to purchase through a bank or another lending institution. So these are the different disparate set of hurdles which these investors for real estate, and this is just for real estate, will have to overcome. So how does RWA, real world asset tokenization, overcome this? Well, it overcomes this through digitizing lucrative real estates onto the blockchain. And then what typically happens is the actual provider or the issuer of, let's say, a Dubai-based luxury apartment, when they digitize that onto the blockchain, they need to kind of create a set of shares, if you like. If you think about shares in a company, you need to do the same thing with dividing up that digitized lucrative apartment on the blockchain in a number of tokens, which is a finite set of tokens, which the total value of those tokens will represent the ultimate value of the actual digitized lucrative apartment in Dubai on the blockchain. So that is kind of the analogy comparison between shares in a company versus tokens in the tokenized asset on the blockchain. That's what we're talking about here through tokenization. That's what it fundamentally means in practical terms. One other interesting insight that I found interesting is that Standard Chartered actually predicts a whopping $30 trillion market valuation for tokenized assets by 2034. As a result of this estimate, Coinbase has done a survey with the Fortune 500 executives where they've revealed 86% of those leaders now recognize the potential benefits of tokenized assets. This is very significant, and this will set the ball rolling down the road of embedding tokenization into the TradeFi mainstream, which is its intention. And it's of no surprise at all that for those of you out there who are investors in TradeFi, you're going to be expecting to receive a handful of calls from your brokers or financial investment advisors advocating for the need to start parting some of your wealth from your portfolio into these RWA assets, because this is the future. I just want to touch on a few of those ways within which real world assets can help provide that kind of fractional ownership, that evolution of making it truly transparent, accessible in terms of opportunity for all, and giving examples how tokenization is poised to actually tokenize absolutely everything and everywhere that we can think of, whether it's indeed real estate, private equity, fine art or collectibles, or fine wine. You can think of anything that has an economic value attached. That is a perfect candidate for tokenization on the blockchain. What are the ways within which we can make or help transform traditional finance onto the blockchain? So this is one of the ways. It's through enhanced liquidity for those historically illiquid assets, as I've talked about earlier on. Illiquid asset transactions can indeed be a lengthy process that usually involves long lockup periods. So real estate is a fine example of this, where it often ties up capital for an extended period of time, just like private equity investments that usually render capital unavailable during that prolonged period of time. So by converting these assets into digital tokens that can be traded seamlessly and transparently on chain, liquidity can become instant at that point. Tokenized shares offer more flexibility than traditional asset structures, attracting a far wider pool of buyers and sellers. A growing number of specialized blockchains, including the RWA-focused Layer 1 Mantra chain, have introduced services to support these tokenized assets. It's true to say there are a growing trend of new fintechs that are sprouting out and involved as fintech players within the tokenized industry, which is very, very comforting. The second way is through regulatory compliance with global standards. What does this mean? Well, we both know that real estate, as indeed private equities, these assets are best suited to tokenization as they hail from highly regulated industries. This means that compliance needs for their tokenization is immense, as are the standards with robust requirements required for know your customer and anti-money laundering frameworks. We all know, as even retail investors, whenever we actually walk into a bank, let's say, and we open up a bank account, well, what's the first thing that the bank will ask us to do? They're going to go through know your customer, those famous KYC checks, right, which is fundamental to ensure the bank that you're a trustworthy depositor, that you have a standard income, whether it's through employment or through other means, that you have a reputable credit score. So in the case that you want to ask for loans from the bank, that you're in a good standing in order to repay back that loan. So these are all of the checks and balances that we are used to in present day traditional finance, going through know your customer checks and balances. And the same on the case of anti-money laundering, just ensure that we're not a terrorist organization, we're not part of a crime wave organization. So these are traditional TradeFi checks and balances. And this is what we meant by regulatory compliance with these global standards. Well, with a blockchain, they would help navigate in terms of abiding by these disparate sets of regulatory requirements for issuers and investors. So that pain will be taken care of by these fintech blockchain operators in the RWA space. That's the bottom line, because at the end of the day, they want to make it completely open and accessible, not within a particular jurisdiction or country, but indeed adopt RWA at a global scale. That's the point. The third way is through lowering barriers through fragmentation and offering user-friendly interfaces. Now, this is very important when adopting RWAs from an investment standpoint. It's not just making those legacy liquid assets, transforming those into digital representatives onto the blockchain in order to make it more liquid. It's to bar investors with lower capital from participating, thereby significantly limiting available buyers. So this is the point. We want to kind of do a U-turn of that and make it completely open. We want maximum number of participants investing in RWAs in these types of blockchains, thereby significantly increasing the amount of capital inflows into the RWA space and onto these blockchains. So the example here is, what if a real estate investor with only enough capital to buy a fraction of a property could buy just a fraction? Well, RWAs make this previously unthinkable trade now possible, as investors can even buy small token fractions rather than the entire investment shares of that property. This is the example I made at the very early outset. Think about the first-time buyers, the barriers that they would have to go through. 5-10% deposit, as I mentioned earlier on, go through the hoops of due diligence, KYC, anti-money laundering with a bank in order to be issued with a loan for the remainder of the investment capital to buy the property and so on. Well, this is the beauty of this. It actually indeed lowers the barriers through this highly liquid approach through RWAs. And then the fourth one, as with every blockchain, the blockchains, in terms of its core attributes, it records each transaction on an immutable ledger. What does immutable means? It means that once a transaction is recorded on a public ledger or a public database, it cannot be tampered with. It can't be undone, unraveled, or tampered with, which is in stark contrast with a corporate database belonging to a major company, multinational, or even a bank, where, since it's under their control, they have that propensity to be able to change the transactions that's recorded on their own ledgers. Well, it's not the case with blockchain, because public blockchains in particular has this added advantage of immutability. So once a transaction is recorded on those public ledgers, it cannot be tampered with. It's mathematically impossible to unravel or tamper those recorded transactions. That is one of the key attributes of a blockchain. It's immutable in that sense. It also provides transparency. It is completely transparent and available to all to see who actually made those transactions. So it reduces risk for fraud or even manual error. That is the key point. And this means that stakeholders and regulators can confirm the ownership and verify histories instantly, adding efficiency to compliance by speeding up processes. And then the final way, which is interesting, is new opportunities that are being unlocked as a result. I have mentioned earlier on that tokenizing RWAs creates entirely new paths for future growth, because it's not just tokenizing real estate. It's huge. You can tokenize absolutely everything, everywhere that you can think of, as long as it's something that has an economic value, an intrinsic value in monetary terms. That's the actual scope of what is meant by tokenizing anything everywhere on the blockchain through RWAs, right? It's converting those real world assets into digital tokens that breaks any geographical and financial barriers, which in turn allows businesses and investors to gain broader access to capital sources. Any verified participant with internet access can trade these digital fractions, enabling both small businesses and global corporations to reach a wider pool of funders. Now, this global accessibility builds the foundation of a range of these new use cases of RWAs on the blockchain. This is the full potential that real-world asset tokenization provides to us investors. And I would encourage you to do your own research and to actually subscribe to my channel, because I have given quite a few educational videos of what is a blockchain, what is real-world asset tokenization. So you can refer to a couple of videos that I'm showing at the top of me. If you subscribe, you can review those, and also some insights and developments in terms of news and developments in terms of how the real-world assets tokenization as an industry is evolving, and surely but slowly, as with Bitcoin, is becoming more embedded into the mainstream, into that traditional finance, TradeFi mainstream arena. So that's it for today's episode. If you've enjoyed it, please don't forget the like button and to hit the like button and to share the video to friends and colleagues at work. And if you haven't done so already, so please subscribe to my channel, as I regularly publish interesting videos such as these, anything to do with Bitcoin, blockchain technology, and the future of finance. So until next time.